So we were talking about the role of banks, in the funding of businesses, and we established that, funding is a major challenge for both small and big, right? And we were trying to crack the code and see how we can give our listeners solutions for their businesses, funding solutions for their businesses, right? Yeah. So please, again, tell us, what you guys do as the bank, just to recap, what you guys do for businesses in order to bridge that gap.
All right. Thank you very much, Tony.
You're welcome.
Like what we said, what is called the risk acceptance criteria, and once you meet the criteria to an appreciable extent, a loan can be extended to you. What again do we need to see? We need to see, we check your character, we check your capacity, we check the capital that you have. Your character is who you are. If we give you money, when do you pay as you are meant to pay back? Do you keep to the agreements? That is the measure of your character. Capacity is measured by your turnover, by how able, how quickly, or what exactly you can pay back. All right, on how you have been turning over your business, turning over your funds, the capital you had by yourself. And the capital is the money you have to do business. In the Igbo parlance, it's called Isiego.
Yeah.
So that is it. Then the collateral is what you own that can be used as security to collect the loan. If I want to borrow money from Rochelle, I can give Rochelle my phone and say, please, my phone is worth 200,000 naira. Hold it while you give me 100,000 naira. When I return the 100,000 naira, give me back my phone. The phone has become security or collateral for the loan. And then the conditions, like we said the last time, what are the surrounding conditions around the customer that will improve or reduce the possibility of the tendency of lending to him, of agreeing to lend to the customer? Is the customer sick? Is the customer well? Is the customer old? Is the customer young? Is he too young? All these are factors.
Is he a sole proprietor?
Is he, yes, he's sole proprietor.
Yeah.
What are the succession plans?
Yeah.
Then what are the conditions he's serving in? Is he in Sambisa Forest or is he on another island? Do you understand? So those are the issues, and these issues will determine how much, how long, and for how long he can get his facility, okay, and how much he can be given, and the conditions all around it.
Yeah.
So that's just about it. Then the type of loans that we have, we can lend to anybody. Like I said on Wednesday, banks are financial institutions, financial intermediaries. We midwife, the flow of funding. So it doesn't matter. We can lend to anybody as long as we are going to make money of it, as long as there's a profit. And the intention is also to make you richer. That's the point. So we have to find who is doing well in business. We have to analyze the business. Then how much can we plug into the business and get out of it?
Yeah.
So for companies, for businesses, we start from small and medium scale enterprises. You have the quick loans. You have the loans that sometimes can be lent clean. We call it clean lending.
Okay.
That means we can extend this facility to you without collateral.
Yeah. But you have to have character.
You have to have character, of course, definitely. It's good. There's going to be an analysis of your business, and so the bank may want to first of all come out and just expose themselves to you, but to a small extent.
Yes.
First of all, to see how well you will perform. Yeah, you will definitely have to give. What usually happens is that you may give us deposited checks as security instead of having maybe an immovable asset, like legal mortgage or something. So that's what will likely be used to secure the facility that will be extended to you. So for companies, you have for sharp loans, and then because those loans are high risk, you get as high risk facilities.
Is that why it's called sharp loans?
Well, yes. Every bank has its name. It has this, they have what they used to call it. You know, you could have quick loans, you could have emergency loans, all sorts loans that that will return within 6 months or 1 year. Those are short-term loans, very short-term loans, and so you know they're temporary advance facilities. They're short-term overdrafts, seemingly. You know, all those are, and so they could be given, free, as in without security, but it usually will be with a much higher interest rates. Than those that are more secure.
Yes.
Okay, so you now have the more secure lending. You have things like overdrafts. You have term loans. An overdraft is that because the customer is given a drawing limit, so he can overdraw his account by whichever amount has been analyzed that he can draw by. Then there are term loans where you are given a lump sum, and then you are given a repayment schedule where you pay down over time.
Yeah.
Now, so all these are determined by your capital and your capacity.
See.
Yeah. So we also have things like trade finance facilities where we help people who import.
Beautiful. We'll get to that.
Okay.
Yeah,
then you also have working capital.
Yes.
Where you could just give the person. Term loans usually is directed at a particular item to be funded. You're either funding, raw materials, you're funding machinery, you're funding building,
yes,
or whatever you're funding. So the money goes directly into that. But you could be given working capital, and the repayment plan for working capital, it's a maximum of 3 years usually.
Okay.
They don't give you the money for more than 3 years. Then all I have mentioned, the rates are usually determined by the NPR. Every time the CBN comes, they sit down.
Please, for the sake of lay people, tell us what NPR is.
Yes. So NPR is a monetary policy rate that is a figure that all the economic indices are to work around.
Yeah.
Okay. It's just a figure that comes out. It's how do I call it? It's what is used to control all the economic indices in the country. So the monetary policy rate says, okay, the CBN says the MPR is at this point. It's usually given another name in banks like the prime lending rate. Okay. So you could lend at that rate without any profits. Okay. So usually what banks will now do is to add, processing the facility, the processes, the salaries you're going to pay, everything you're going to do that involves that facility, and then the profit you should make on top is what usually is the percentage amount that is added on top of the MPR. Okay. So, sometimes they will say, but CBN says it is 26.75. Now, why are you charging me at 35%?
A good question.
The reason is that the banks are not there. They are not NGOs.
Yeah.
Okay.
There's a cost to processing those facilities. The person processing the facility has to be paid.
Yeah.
The MD down to even the cleaner has to be paid.
I want to throw this in. Sorry to cut you right there. You see, sometimes it looks like the CBN, the banks, and the customers are not on the same page. From what you're saying right now, the CBN stipulates a certain, policy, and the banks do another. That also happens because I've interacted with at an event we had, and a top CBN official was talking about, that the banks shouldn't charge you insurance and all of that because the money is already insured, and that there are a number of things that they charge on the loan that they give that they shouldn't be, charging. So I wanted to ask you quickly, why is that? Why does it appear the CBN, the commercial banks, and the customers are often not on the same page?
Well, a lot of times, there may be no need for explanation when you have told the customer this is how much you're going to pay over time.
Yeah.
The customer accepts it, the loan is disbursed, and the customer pays. Everything moves well. What now happens is if extraneous factors come in and the customer begins to have challenges paying down, it now begins to look like the bank is now becoming ruthless. The thing is this, loans are not for free. We are regulated, and there's a certain fee that is also remitted in terms of payments. In fact, once you give a loan, it's provisioned against the bank. It's provisioned against the bank. So all that is at a cost. So what happens is that when the loan is given, it has to be given against the MPR that has been set by the bank.
Yeah.
Okay. The MPR it also includes the interest you must pay to customers.
Okay, so the MPR is set locally by the bank and not the central bank.
No, it's the central bank.
Okay.
That's why I say all economic indices, everything we need to do to pay. Like when you go to put your money in the bank. Okay, when you put your money in the bank, it is the banks are mandated to pay interest on that money relative to the MPR.
Yes.
So as MPR changes, this is what. So that's why you see your fixed deposits. They could tell you, oh, this is the amount, this is the rate we're giving you this month, and it has changed the next month. It's always because the MPR has changed, and all that is relative, is proportional, to the MPR. So same thing with the monies we lend to customers. So you see, when we lend monies to customers, for the bank, it is in the customer's interest that he pays insurance. For instance, if anything happens to the customer's business, insurance pays for it, and we don't have to continue to go against the customer. What insurance pays for?
Are you insuring the customer? Because I've seen that on a number of facilities. So is that insurance for the customer or insurance for the bank on the loan they're giving to the customer?
The bank is what is called the first loss payee. Yeah. So if, for instance, we fund a filling station, we give it an overdraft, and the station is raised by fire, and insurance has to pay for the station, the insurance company will pay into the bank the account number of the bank that funded the station, and not directly to the customer. So in essence, the bank is insured against the loan they give the customer.
All right.
Okay, so that's it. As long as nothing happens to activate the insurance policy, it's still the customer's problem.
Yeah.
The insurance company will not pay unless an unfortunate incident occurs, and when the insurance company has to come in. Okay. So now those are for companies. I wanted to also mention that there are intervention funds, however, that are independent of the MPR, because for now you are hardly going to see a bank that will lend to you using their own funds at less than 35%. Because this is a combination of the MPR, the CRR, and all that. CRR is just the ratio, cash reserve ratio, that's showing how much of the deposits banks cannot touch. It's sterilized. So we need to understand that. If you could say, so while banks have to pay interest on every customer who has a savings account, we cannot touch 45% of that money. We can't use it for business, as stipulated by the CBN. So it's only 55% of those funds that we are utilizing. And so that's why you find out that they have to tinker with the figures in finance, such that even though the MPR is at 26.5, for them to be profitable, in the least to pay salaries, to run their business, to run operations, and all that you see, with the network, they have to add all the difference to what you see. So you see banks lending at 34-35% right now, per annum. But then there are what they call intervention funds. Intervention funds is liquidity provided by bodies like the Development Bank of Nigeria, the African Development Bank, Bank of Industry,
CBN. Sometimes
CBN has now left that to face monetary policy. They were more interventionist during.
I noticed that since this administration, we haven't heard of intervention funds from CBN.
A lot of issues came out of that. It's what's called the clearing of the Augean stables.
Okay.
So that is it. So the CBN is no longer, for now anyway, but you have these other intervention funds that come in. And what do? They have a handshake with the banks and say, okay, we may not know, we don't have the time or the knowledge of these customers as much as you do.
Yeah.
So use your risk acceptance criteria, analyze the facilities, and if they are acceptable, if the customers' conditions, if circumstances are acceptable to you, these are the funds we are giving to you at a particular percentage. So you return to us, these monies. So for instance, the Development Bank of Nigeria is at around 22-23% now. What now happens is that the bank will now lend at a premium, in return 22% to the
Beautiful. You just answered the question I have been needing an answer for.
Okay.
Remember, I said that I'm part of the leadership of an organization that houses about 250 CEOs and companies, right? Yes. And the feedback we are getting is that there are intervention funds that are supposed to be single digits. Well, this was before this administration. They were supposed to be single digits. But we're beginning to get feedback, and that led us to begin to suspect that the banks are taking these intervention funds and repackaging them, and offering them at a higher, at a premium, higher than the single digit that, the Bank of Industry or CD or whatever, as the case may be, was offering it for. Yes. So I begin to see, that's allowed from what you just said.
Obviously, that's the business.
Because if you go to central bank says, no, that thing is supposed to be for 10%, 9%. So who is that person that's giving it to you at 25%?
No, that's a misunderstanding of what happens.
Yes.
If Rochelle tells me, I have 10 million naira, take 10 million naira, do business with it, return 10 million naira to me at 10%. And she gives me 30 days. Yes. So I have to return 11 million naira to her, because 1 million naira is 10% of 10 million naira. Yes. If I run around, find the customer, process his facility, or process the business, do everything, and make exactly 10%. I charge the customer only 10%, and I bring it to Rachel. What have I done? What did I use to process all this? Where is my gain in it? Yeah. Okay. How do I pay salaries? How do I run the business?
I see what you're saying.
So there must be a margin that the banks will make, and that is a percentage.
No, we thought the CBN was sorting you guys out somehow.
In fact, we have to pay. There's a lot that has to go back to the CBN. So that is it.
All right.
So those ones, BOI, you could still get at 10%. But you have to meet the criteria to get monies from BOI, and they fund usually machinery, large sums, machinery, manufacturing, and all that. So that's where they are. You could still give you working capital. That's right. But the percentage for working capital will be slightly higher than if you were, it was a regular term loan where you had to buy machines. BOI is probably the cheapest right now, but it's may not be the easiest,
Or they don't actually give the cash; they pay the manufacturer.
So you see, that's where it is. That's I try to explain the issue of term loans, where they fund directly. So the money will go directly to
the manufacturer,
who is supplying the raw materials, and then you will now pay either the raw materials or the equipment. The equipment, and then you now pay over time. Okay, now that's for. Sorry, I'll just wrap up. That's for companies. For individuals, so there are others. So let's get it right. The intervention funds now make the cost of the loan less than if you're taking from the bank itself.
Yes.
So as long as those funds, and you see, as it is spread, as people are paying back, it becomes more available to others to take.
Yes.
So sometimes it could be exhausted, but as repayments come in, it could now become more available. So banks that key into it now have such abilities to lend at lower rates.
Beautiful.
Good. So now you now have payments to. Okay, you have how do customers get money? Probably that's what you're saying. It's not just by lending. I hope you know.
Yeah.
They're like commercial papers where a company might say, I don't want to pay 35%. I don't want to even pay 29% or 28% of what intervention funds are giving me now. I need to raise commercial papers through a bank. Banks will still midwife it. By saying, okay, give us these funds, we'll pay you 21%, we'll pay you 22% after 9 months, or after 6 months or 9 months, thereabout. So that's also how companies can raise funds from the market.
Oh, beautiful.
Yeah.
I'm interested in that. Please throw some light. Yes.
Okay, so you have commercial papers are like, well, please, I've never met Dangote in my life.
No, that's
so
okay.
I just want to give an idea. Why. So Dangote could come out and say, okay, why do I have to pay 35% if I'm known? Okay, then you now go through a bank, the asset management arm or something, and say, okay, I would like people to buy commercial papers are debt instruments.
Yes.
So to buy these debt instruments, and I'm ready to pay down, there will be the 180-day paper and the 265-day or 270-day paper.
Yes.
So it's usually that's 6 months and 9 months. So whoever is ready to give me his money for 6 months, I'm ready to pay the person 18% per annum. Okay. Whoever is ready to give his money for 9 months, I'm ready to pay the person. These are what do you call them? Arbitrary figures. I'm just putting out now in terms of the percentage. So these you can now say for 9 months I'm ready to pay 21%. Usually the longer the tenor, the higher the interest rate. So 21% as against 29 or 35%. It's much easier for the company. So you now if I am an individual and I hear that a Dangote, a blue chip company, is ready to pay me 23% per annum, for instance, for keeping my money for 9 months.
I'll be happy to invest, especially since there's a bank midwife in there.
Exactly. And the banks usually have their criteria for knowing who. It's not everybody that comes to them to say, okay, I would like to sell commercial papers that they will take, And so that is it. So banks can raise money from markets. They also what they call IPOs, initial public offerings or public offerings, like what almost all the banks are doing right now. And then also then you have bonds and bills. But bills are for companies. You have those are what comes out as commercial papers and all. But for bonds are debt instruments that are more than 1 year. So you could have those corporate bonds. Yeah. You have sovereign bonds. That's right. So corporate bonds are what they also use to get money from the market. Yes. Give me your money for more than 1 year, and I will pay you this amount. Okay. Usually in coupons of quarterly payments. So and the banks still get involved in the process, in the packaging. Yes. Okay. So like even Nigeria has issued even a sovereign dollar bond now. They're even ready because they have because of the reticence of people or reluctance to even keep money in naira now. They're now saying, okay, give us your dollars, we'll pay you this in percentage also. But there are naira bonds also all over this. So that's for sovereign bonds are for the country, corporate bonds are for companies. I'm just trying to tell you how people raise funds from the business. Then of course mergers and acquisitions help companies get bigger. Absolutely. Then you also have angel investors or venture capitalists. Who are these? So Tony, let me stop using Rachel all the time. Tony wants to start a business. He wants to start a business. He has a very good idea of, making gods, or he has found a need in society and has a compelling argument on how to get it done and make money. He has done his cash flow projections and all. All he needs now is investment. So there are people who now see it. He doesn't have any form of financial experience. So an angel investor, so that's what they call an angel investor, or a venture capitalist will now come out and say, okay, I'll give you $100 million. Go ahead, start, or 100 million naira for saying, okay, do it, make sure you get everything you need to do. And then after 5 years, start paying me back this amount. Beautiful. So that's what happens. So those are the things for companies and businesses. So we started with the small businesses and have gone right up to large corporates and how they can raise money. So for individuals, for instance, who should constitute the larger proportion of our listeners, you have things like a salary-backed loan. If you work for the government or for a profit-making organization that probably is categorized, you could be given a term loan that you could pay back over time. I think I might want to put a hold on the individual loan because really we're targeted more to businesses. And on account of time, I still have some questions I'd like you to answer. Yes. So I want you to tell me, overseas, I've had this experience myself. You could get funding on the basis of the strength of your business plan and not necessarily on equity
or collateral, right?
Yes.
And that's beautiful. And for so many years, I've hoped that Nigerian banks can actually begin to do like hardcore banking, where they don't wait for customers to dot all the I's and cross all the T's before they get facilities. Are we there yet? Or is this something we're hoping to see in the nearest future?
Okay, so in 2019, between 2019 and now,
Yes.
there was an improvement in that regard.
Yeah.
So businesses, small scale businesses, began to see there was a lot of influx in the support
Yes.
of such by banks. The banks will look at their portfolio, they'll look at their size, they'll look at their capacity and say, okay, we can decide to start lending. And that's what in Nigeria we call clean lending.
Yeah.
So the customer doesn't have collateral.
Yes.
So let's start with 500,000. Let's see what he can do with it.
Yes.
So they can say, okay, we've earmarked 5 billion naira. That's a sector limit.
Yes.
Sectoral limit for lending to the small scale industry, small scale business people that may not have collateral.
Yeah.
So we can make do with 5 billion, and then they will have what is called a non-performing loan ratio,
Yeah.
an allowable ratio in that sector. Usually CBN says all banks should not go below 5%. Globally. What does global mean? All the different sectors.
Yeah.
So what that means that there will be certain sectors that will have 0% and may have a large volume. For instance, up till now, sovereign borrowing, Nigeria still pays back its loans.
Yes.
Okay.
Yes.
So if the bank decides to lend to government, maybe the federal government, the largest chunk of its or large chunks of its of its global limits will be to government. So if that one has 0%, you could afford to have 15% in the sector for small scale lending.
Yes.
Okay.
Mm-hmm.
By the time you net it off using the volumes, the total ratio could still be less than 1%.
Correct.
If you understand what I'm saying.
Yes. Yes.
For instance, you put 5 billion as the limit for small scale industries, which is high risk because they have little or no experience financially in financial management, or that you can see, that you can analyze. You're only using their turnover.
Yes.
You haven't seen how well they are profitable. Okay. As against maybe 200 billion you've lent to government.
Yes.
200 billion at 0 MPL and 5 billion at maybe 15% MPL. By the time you get the averages, the 15% MPL, it will be much lower.
Yeah.
So that's it. So that's what happens. So it's happening. Banks are beginning to lend out and to give small industries, but I must tell you that the economic climate is still, in fact, it has worsened.
Yeah.
But there are still people who are doing their best, to pay back.
Yeah, nice.
Restructuring is going on.
Yes.
And banks are also cutting their losses
That's right.
and moving forward.
Yeah. All right. I have a lot of questions, but really we've run out of time. So I'll ask you just this last one. Now, can a sponsor who wants to support a business, right? I'm a businessman, and I go to Mr. James and say, hey, listen, I have this business that I want to do. It's really profitable, but I don't have the money, right? Can you help me? Mr. James says, I would have helped you. I can see that this business is good business, but I have money tied down in other ventures or investments, right?
Yeah.
Okay, go to this bank. I will provide them a bank guarantee so that they can fund your project. You get the question? Is this something that is doable? And is this something that your bank or any bank, will be happy to get involved with it, to see how we can help businesses move forward?
Okay. So it's called a third-party guarantee.
Yes.
So third-party guarantees so why is it called third party? First party is the
Guarantor.
Is the bank. Second party is the customer.
Yeah.
Third party is the guarantor.
Yes.
Third party guarantee is saying that I will guarantee. But you don't just guarantee by word of mouth.
Yes.
Such guarantees are really backed by
a proper bank guarantee, a financial instrument.
Yes. What happens if you want a bank guarantee is different. That's not the bank guarantee.
Okay.
That's the bank is giving it based on the guarantee of probably its own customer.
Yes.
But then his own customer will have to say, okay, I have money I have fixed deposits because it has to be liquid. I have fixed deposits in your bank, or I even have treasury bills, but I bought through your bank or bonds.
Yes.
Okay, mortgage those funds against the
guarantee we're giving to this.
The loan
you
want to give to this person. I'm guaranteeing it.
Okay.
And the bank midwives it. But that's different from a bank guarantee. What a bank guarantee is you have business. You have a business proposal. Okay, and you want to do, or let's say there's a contract from the government. The government now needs a guarantee that you will do it. So when you come to the bank evaluates the risk of the contract, how it can be paid back.
Yes.
What is the total funding involved? And then we'll now tell you have to provide the collateral or the security for such funding, either in cash or by legal mortgage. That's your property that is properly titled, and then they will now give you the guarantee. What the guarantee will say is, if you don't perform, the bank will pay.
Okay, all right. We have to leave it there because we've run out of time. Thank you once again, Mr. Joshua, for coming.
Thank you very, very
It's been a very insightful and educative one.